Hello and welcome to today's webinar. Today we are going to be talking about rethinking alternatives, the case for carbon in 2026. And I think you'll all agree that alternatives has probably been one of the hottest conversations last year. And I think with everything happening in markets already in 2026, it's going to be a topic that we talk about a lot this year. So hopefully we can shed a lot of light on this. A little bit of housekeeping before I start. If you're on the website, you can email us any questions and we will answer them during the course of the webinar. So please feel free to do that at info@KraneShares.com. We're also offering continuing education for CFP and SEMA. So if you want to get credit for joining this webinar, we give 1 credit for that to your organization. So email us on ce@KraneShares.com. So any questions, info, if you want the deck, info@KraneShares.com. We'll be happy to share that afterwards. Any questions during or after, please send them there. If you're watching this in the app, you can see a Q&A section. Please answer or ask questions there, and I'll be taking those in live and feeding them back to either myself or a very special guest today, which brings me on to, I'm Luke Oliver. I run strategy and our climate products here at KraneShares, and you've probably seen me on a few of these before, but today we have a very special guest. Mark Lewis has joined us. He's joined Climate Finance Partners, which is the sub-advisor to our carbon funds, KRBN, KCCA. And he joins us as probably the most preeminent name in European carbon markets and global carbon cap and trade systems. So incredibly happy. Welcome, Mark. Now, what I'd like to do...
Very much, Luke. Sorry, there was a slight delay on the line there. Thanks very much. It's a pleasure to be with you this afternoon.
Yes, no problem. Sorry, I threw you in a little early before we got to your slides, but let's get into it. We can just go to the next slide and get into let's get to the carbon tickers that I think everyone's eager to hear a little bit about. Obviously KraneShares is a global asset manager. We have a full suite of products focusing on emerging markets, carbon, and alternatives, and of course China and carbon themselves are some of the strongest contenders for an alternative portfolio. So very excited to talk about that today. But let's drill down now to the topic of the day, which is carbon. We have had an incredible 2025 year in almost all markets. We've had an incredibly interesting and volatile start to 2026. And what all of that really kind of brings to the surface is the fact that we've got extended valuations on so many assets. We have a geopolitical instability, which is putting currencies, and specifically the US dollar, under a lot of pressure. We're seeing trends of deglobalization, and we're also seeing the fact that investors want to preserve capital in a high inflation environment. So when you have high inflation, high valuations, geopolitical instability, you look naturally for alternative investments that are going to reduce the overall portfolio volatility of your portfolio. And so what has been probably the best alternative that people have sought out over the last couple of years, and notwithstanding the last week or so, but gold has been an incredible alternative. And what's made gold a great alternative is that gold is an asset that has a relatively fixed supply, and when people move away from the dollar, when they move away from risk assets, they safe harbor into gold. So the demand for gold increases and gold performs very well. So gold has always performed very well relative to inflation. So why am I talking about gold? Well, when people think about what the perfect alternative is, it's something that has a high Sharpe ratio, which means it has a good return relative to the amount of risk and volatility that asset has, and also has low correlation to equities. So if you can find something with a great risk return with low correlation to equities, you found a great alternative investment. Another big trend that we're seeing is a lot of private equities being brought into public markets, which actually reduces their value as a diversifier. And so we are seeing increasingly institutions are looking for better alternatives. Now, gold has been a fantastic alternative. But if we go to the next slide, we're going to start to see something else emerging. Look at the 5-year run of carbon, gold, and US equities, the S&P 500 index. And you will see that over the last 5 years, gold has performed fantastically, 131%. The index that we track in KRBN, which is our global carbon fund, has returned 102%. And the global equity index, the US equity index, S&P 500, has returned 96%. So first of all, I bet almost all of you are very surprised to learn that actually stocks were the lowest performer of these three things. US stocks have always, over time, been one of the best investments you can make. But in fact, over these 5 years, both carbon and gold have outperformed, which means they've been a good alternative to the S&P 500. You will notice, however, the S&P 500 probably has been more reliable and smooth in those returns. So first of all, take note of that. These assets have all performed very well over the long-term horizon. Now let's go to the next slide, because this is what's important. People recognize gold and understand that you almost have to have US equities as your core, but when you look for alternatives, gold is a very well established and liquid asset. The problem is today, gold, even after this sell-off we just had, is still only 8 or 9% below its all-time highs. US equities, 1% below its all-time high. So even the emerging markets, which a lot of people see as like a alternative allocation away from US and developed markets, is also only 2% away from its all-time high. So when all the things that you use to diversify, while they may still have low correlations or lower correlations, they are screaming all-time highs. So when you're looking to diversify away from something you think is expensive, buying something else really expensive doesn't always quite feel right. So we are on a hunt for an alternative. And this is where we think carbon, we're going to hear a lot more about the details here, we think carbon is potentially the best alternative for investors to take a look at as a potential allocation in their portfolio. Why? Because carbon has a low correlation to stocks of 0.3, which is comparable to commodities. It is also way off its highs. You can see here 37% off its highs. So even to get back to previous carbon highs, let alone what Mark's going to talk about is the kind of bull case for carbon. We have a long way to go and a lot more, potentially a lot more run in carbon. If we can go to the next slide, this isn't just long term. Let's look at last year. So last year was gold's, was a fantastic year for gold, up 67%. Stocks were up 18%, and the global carbon basket was up 23%. So carbon is beating stocks in the 1 and 5 year, not in the 3 year. Gold is beating stocks in the 5 and the 1 year as well, also not in the 3 year. But that's why you build a portfolio of all of these assets. And when you then break down what is in carbon, this is where it gets a little more interesting, is there's actually 5 different markets that are in our global carbon that all perform very differently and are diversifiers to themselves. So in fact, the best performing carbon market was the UK and actually outperformed all of these markets. You can see here, UK was up 76%. As a US investor, I also earned the fact that the pound strengthened against the dollar. So in our carbon portfolio, our UK allocation, which is 5% of the portfolio, earned 96%. Same for Europe, it was up 16%, but we got about a 30% return from Europe because of the depreciation of the dollar versus the euro. So if you can get exposure to these highly diversified, potentially large growth area carbon, plus getting away from that US dollar, which is a big theme around people also moving into gold, I think it sets up a really interesting trade. So if we can just go to the next slide here, I'm going to touch on this ever so briefly, just to tee Mark up, which is what is this carbon market and what dynamics are at play. And simply put, just like we all understand gold, there's a set amount of gold. It's very difficult to add new supply of gold. So when the demand for gold goes up or down, so will the price. And so as central banks add gold, there'll be more demand, the price will go up. Carbon has a very similar mechanism. They're government-run programs that have a very fixed supply, and in fact have a supply that is designed over time to be tapered lower. So you can see here the supply lines for the European market. As those lines go down, the market gets tighter, prices move higher, and they are designed to have one super cycle out to 2050, which is to increase the price of carbon to help the European economy monetize their transition to lower carbon fuel, lower carbon industry. We'll take it one step further and go to the next slide and look at how the California market, which is the second largest market, not only does it have tightening supply, but it actually has floor prices and tiers and ceiling prices that all increase by 5% plus inflation. So there's a direct inflation push embedded in these markets. I won't spend too long on this. This is one of my favorite charts, but we'll get to it later. But simply put, we are in a market that has most assets incredibly expensive. We are looking for diversifiers so that we have more resilience in our portfolios when we start to get shocks, whether it be to equities or gold, as we've seen, or Bitcoin, or emerging markets. And we need something that moves or moves to its own beat. And carbon structurally is designed to move in real terms, i.e. above inflation, between now and 2050. And as we've seen, 1 year, 3 year, 5 year, you look at all of those very attractive returns, plus that low correlation to equities that we expect to be maintained. So this is a highly interesting topic, and there's no one better to dive into this than Mark Lewis. So Mark, so happy to have you on board. And before I hand over, just so we don't skip the slide, it's not just me and Mark talking about this. If we go to the next slide, there's been numerous. The CFA Institute recently published a series of papers on these markets. I think they published 3, and they're intending to publish a total of 5. And Cambridge Associates, a big institutional consultant, has written quite extensively, especially on the California market, as well as there's been a few business books written on the topic as well. So before, just to tee that up, that we're definitely seeing the trend towards this market institutionalizing. And of course, this isn't a niche market. This market traded $1 trillion in 2025. So the massive institutionally liquid market. And what we did at KraneShares with Cli-Fi is launch a set of ETFs that enable all investors to get access to it. So with that, thanks very much, Mark. I'd love to hand the reins over to you to take us through these markets.
Well, thank you very much, Luke, and good morning, everybody. Good afternoon, wherever you're dialing in from. It's a real pleasure to be with you today. As Luke said, I recently joined Cli-Fi, Climate Finance Partners. We are the sub-advisors to KraneShares on the carbon products. And I myself have 20 years experience covering global carbon markets, began covering the European market when it came into being in January 2005. So I've been there since the beginning, seen a lot of ups and downs. And really, as Luke suggested, what's so exciting about the European markets in particular is that because we've already got 20 years of experience behind us, we are now entering the period where things get real, get very serious, where decarbonization has to be done at an increasingly higher price. And that's why this is an exciting time for the European markets, by which I mean both the EU and the UK at this point in time. But also, and we'll focus at the end on the Californian Cap and Invest scheme in terms of the North American markets, which are further behind in their development than the European markets, but which nonetheless, as Luke indicated, have exactly the same kind of structural principle with a declining cap and therefore rising price tension over time. So the way I've divided this presentation is into 3 parts. I'll talk first of all about the EU market, which is the longest standing cap and trade market in the world, the deepest, the most liquid, and currently the highest priced. We have a carbon price in Europe today of about 84 euros, so about, call it $95 a ton. Recently, 2 weeks ago, we were above $100 a ton. So this is a market that is already pricing maturely, but where we think there is scope for prices to go higher over time as the industrial sector has to start decarbonizing above and beyond the power sector. The UK market is also going through a very interesting period because it has its own supply and demand dynamics, which are also pointing towards higher prices over time. But the UK now is looking to link its carbon market with that of the European Union, which effectively means UK carbon allowances are a proxy, a discounted proxy, because they trade at a discount to EUAs. They are a discounted proxy for EUAs. In other words, a cheap way of getting exposure to the EUA story. So we'll look at that one as well. And I'll conclude, as I said, with some comments about the Californian scheme, where we are on that, why we think this is also a very interesting moment for California, before handing back to Luke at the end. So if we could start, please, with the first slide on the EU. So let me say, by the way, I mean, I've said there a new pricing dynamic, and that's really the message I want to get across in the next 15, 20 minutes. As a prelude to the slides we will go through together in a moment, what I mean by that very simply is that for the first 20 years of this market, it's been the power sector that has been driving prices. Those of you who've followed the market closely will be aware of the so-called fuel switching price. This is the price at which power generators switch from coal-fired generation to gas-fired generation. In other words, from high carbon intensive fuels to lower carbon intensive fuels. And traditionally, really, ever since the inception of this market, the fuel switching price has been the best proxy for where the EUA price goes. And really what we're arguing, and what I will put forward to you today, is that we are moving away from that traditional carbon pricing paradigm, where the cost of fuel switching in the power generation sector has set the price, to a new pricing paradigm where it is the industrial sectors, the steel sector, the cement sector, the oil refining sector, that have to increasingly take on the burden of reducing emissions, because the power sector is decarbonizing anyway with the rise of renewable energy. So that's the thesis. Let's go through a few charts to back that thesis up. First of all, let's start with a recap of what happened last year. EUAs were up 16% in 2025. And we had a very good start to the year for the first 2 weeks. And then again, some of you will be following this closely. We had the controversy over Greenland, President Trump threatening tariffs on the European Union and the UK, which took took prices down a little bit immediately, because clearly there is an impact on the real world if ever the United States were to increase tariffs on Europe for whatever reason, then clearly it makes it more expensive for European exporters to sell into the United States, and other things being equal, reduces the level of industrial demand, and hence industrial demand for carbon allowances. However, that threat was withdrawn, as we all know, and prices came back. So, if we look middle of January, the year-to-date high so far is 93 euros and 82 cents. That is, as I say, it's roughly 105 US dollars a ton. We've come back, we've dropped about 10 euros in the last 2 weeks, partly because of the tariff issue, and partly then because gas prices increased over tensions in the Middle East. So geopolitics are a feature of this market, but the basic point is prices have held remarkably stable after a strong performance during 2025. And that gives us confidence that this change in the pricing paradigm is real and is going to drive prices higher over time. So that's a review of what happened in 2025. Let's turn to the next chart. And really, this is the core of our thesis, that the traditional correlation between European carbon prices and European natural gas prices has broken down. And what this chart is showing you is the correlation between the EUA, the light blue line is showing you the price of EUAs, European carbon allowances, since the beginning of 2023. And the dark blue line is showing you the price of European natural gas prices, so-called TTF. That's the main trading hub for natural gas in the European Union. And you can see that over the first 2 years shown on that chart, from January 23 until, let's say, January 2025, the pattern of prices is very similar. When natural gas prices go down, carbon prices were going down. When natural prices were going up, carbon was going up. And then you can see quite clearly there is a change in that pattern from the beginning of 2025. Carbon prices went up for most of the year in 2025, and natural gas prices came down. Now, that is not for such an extended period of time over the course of a whole year. That is something new in this market. And I argue what is new is that the power sector is no longer driving the price of carbon. That what the market is now looking at instead is looking forward to the industrial abatement that will have to happen in order to clear the market over time. But this is, yeah, Luke, yeah.
Do you mind if I just interject for a second?
Of course.
And just what I was thinking was for some of the people that are maybe less familiar with why intuitively they did correlate, like, and just mechanically, the way I think about it is if you're burning coal as a power station, you're buying a cheaper fuel than gas, but you're having to buy more carbon credits because the CO2 emissions from coal is higher per unit of power than gas. So if you're burning more coal, you're buying more allowances.
You're buying twice as much carbon.
Twice as many. And so if the price of allowances goes up, you probably are going to switch to gas. So as carbon goes up, the demand for gas increases and gas comes up as well. Also, if gas gets cheaper, then people will burn more gas, pollute less, buy less carbon. So carbon may come down. So that's intuitively why we observe this relationship that's now breaking down.
That's exactly right, Luke, and that's a very useful clarification. So that is why that correlation has held very strongly over the last 2 decades, but it's breaking down, and that breakdown in the correlation is telling us something important about the change in the pricing paradigm. So if we could go to the next chart, please. And what you see here is that the European power industry is decarbonizing structurally on its own now. In other words, it doesn't need a high carbon price anymore to reduce emissions. What this chart shows you is the breakdown of total power generation in the European Union between fossil fuels, nuclear, and renewables. And if you go back to 2016, you can see that fossil fuels accounted for 45% of total power generation, renewables accounted for 30%, and nuclear for about 28%. Now, while nuclear has maintained a pretty stable share in the overall generation mix, fossil fuels and renewables have completely flipped. If you look at the state of play today, it's renewables that are accounting for 45% of generation and fossil fuels for only 30%. The reason that is happening is that renewables no longer need a high carbon price to incentivize the economics. Solar costs have come down, wind costs have come down. So the power industry is decarbonizing anyway. And one other point, which is important here, lots of coal-fired power stations in Europe have been shut down. So even the scope for fuel switching in the EU is reducing dramatically over time. And indeed, in the UK, there are no coal plants left. So in the UK market, fuel switching is no longer something that drives the price of carbon, because you can't fuel switch. You only have gas, and then you have renewables, and they do not switch depending on the power price. They switch in terms of whether there is enough sunshine, whether there is enough wind. So this is why the power industry is becoming less and less important in the pricing of carbon over time. Next chart, please. Now, a very important feature of the market over the last 12 months has been the rise in speculative positioning in this market. And I'll come on to the main reason for that in a moment. But if you look at this chart, it's showing you ever since end of 2019, beginning of 2020, the evolution of net speculative positioning. In other words, you look at investment funds in the market, hedge funds in particular. How many of them are taking long positions in EUAs? How many are taking short positions? And the black line on this chart, which is the important one, is showing you what the net position is after you aggregate all of the long positions and all of the short positions. And what you see, what you notice very clearly, is that that black line has gone vertical over the last year, really since April 2025. And until 2 weeks ago, in fact, 2 weeks ago, we had the highest ever net speculative length in this market of 126 million tons. In the last 2 weeks, and this information is released every week, every Wednesday, so we had the latest update this morning, and it showed that that positioning has come down a bit. The length, some of the length has come out with the jitters over President Trump's tariff threat and with the geopolitical tensions in the Middle East and higher gas prices, which again led to lower carbon prices in the last week or so, which is counterintuitive relative to the old pricing paradigm we were just talking about. But it's still a very healthy level of speculative interest in there. And so it's speculators really that have been driving the price of carbon over the last 12 months rather than the power generators whose demand for carbon is declining over time as that sector decarbonizes. So if we then look at the next chart, we can get into the reasons as to why speculators are taking such a positive view of prices in EUAs going forward. Now, the next couple of slides really contain the entire thesis around EUAs. As Luke said right at the beginning, the structural principle of cap and trade schemes is that the supply is fixed in advance and it declines over time. And in the case of the European Union, this is showing you the cap on emissions every year out to 2040 based on the legislation as it exists today. So as the legislation exists today, the cap on emissions is falling to zero by 2040. In other words, unless that legislation is rewritten, and I'll come to that in a moment, no industrial company in Europe, no power company in Europe would be able to emit a single ton of CO2 beyond 2040. Now, it is, of course, and the European Commission has finally figured this out, it's not physically possible for EU industry to reduce its emissions physically to zero by 2040. So there are already some discussions around about how could this trajectory for the cap be modified going forward. And indeed, there was some news on this overnight, which I'll come to in a moment. But nonetheless, although this will be subject to some changes, you can see this is a very, very dramatic reduction in the cap over time within a very real, meaningful time horizon. You know, this is only 15 years away. And on the current legislation, you wouldn't be able to emit any CO2 at all. So what the speculators are saying in piling up these long positions is, well, my goodness, prices have to go up if the cap on emissions is falling, because this asset class is becoming scarcer and scarcer every year as the cap declines, unless emissions fall equally quickly. And of course, the whole point is emissions cannot physically fall as quickly as the cap is designed to fall at the moment. So that's the first point. The supply is declining very sharply over the next decade and a half. Next slide, please. And this is the flip side of that. We know that the supply is declining quickly. Emissions, however, are still at a high level. We have about 1 billion tons a year of emissions at the moment, just over. And so if you look in particular at our forecasts and the forecasts of other market commentators and market analysts over to 2030. So if you look at 2025 through 2030, you can see every year there is a projected drawdown in allowances. In other words, demand for carbon allowances will exceed the supply of allowances in every year between now and 2030. And what that means is, because there is an accumulated inventory of allowances in the market, which we'll show on the next slide. But in any commodity market, when you have inventory declining, Commodities 101 says that prices go up, because if the inventory is drawing, it means that commodity is becoming scarcer in real time right now. So that is really the constructive argument for EUAs going forward. And if we look at the next chart, well, actually, this next chart simply aggregates cumulatively the annual deficits that were shown on the previous chart. In other words, we expect a deficit this year of 149 million tons. And if you add the 2027 deficit to 26, it means over the 2 years, there's a deficit of 290, which means by 2030, we are projecting a cumulative deficit of nearly 500 million tons, which means the outstanding inventory in the market will fall by 500 million tons by 2030, which is, if we go to the next slide, that's what we see. So if you look currently at our estimate for the outstanding inventory in the market, the total number of EUAs that are out there held on company balance sheets or in investors' accounts with the European registry, at the end of 2025, that was 901 million tons on our estimates. We don't have the official figure for that yet. And because we expect that to draw down by nearly 500 million tons by 2030, you can see that we are projecting 404 million tons of outstanding inventory by 2030. There are more aggressive estimates out there in the market. This is a blended kind of average of the expected drawdown. But the basic point is, the essential point is that in any commodities market, when you see inventory drawing aggressively, prices generally go up. That's the signal for prices to go up. And here, the reason prices need to go up is that industry needs to start discovering at what price levels they can decarbonize their activities and continue producing in a less carbon intensive way. So in a nutshell, that is the argument around the investment opportunity in European carbon allowances. I will say, because it's very topical today, in the last 24 hours, we've had a widely circulated media report from a German newspaper saying that at an event yesterday, one of the European Commission officials floated the idea of tweaking the reduction in the cap beyond 2030. So there can't be any changes made between now and 2030. So we know that the market is going to be super tight between now and 2030. Beyond 2030, and this is not the first time that they have floated this idea, it's been out there for at least 3 months, which is why I think the market sold off initially yesterday and this morning on the on this news story, but has absorbed it, thinking actually there's nothing new here. We knew that at some point this would have to be revisited, because it is simply not possible for EU industry to decarbonize 100% by 2040. That doesn't mean that the market will still not be tight beyond 2030, which is the earliest date by which they could tweak that cap trajectory. So I just wanted to throw that in there, because some people may have seen the price action over the last 24 hours and been a bit bemused by it. But actually, as I was checking just before the call started, prices are actually up on the day now. So this is a market that has been around a long time, knows now generally to deal with the political risk that comes along. And we've had a lot of it in the last 2 weeks, as I said right at the beginning of the call. But the basic bottom line is that the cap is falling aggressively. It's falling more quickly than European industry can decarbonize its activities, which means prices will have to go higher to discover price levels at which decarbonization can take place. And nobody really knows what those levels are. So I'm not going to sit here and give you a formal price target, but we know, what I can say very confidently is the price of decarbonizing steel activities, the price of decarbonizing cement manufacturing or oil refineries is significantly above the level at which carbon is trading at the moment, the 84 euros a ton level. And one final thing to say on this, I've dwelled a long time on Europe because this is the biggest market in the world. It's responsible for 80 to 85% of all global turnover in carbon markets. That $1 trillion that Luke mentioned, about 800 billion of that is European. So that's why it's worth dwelling on this. It's the biggest, most liquid market, and it's the one where we are poised for a step change in the pricing paradigm, which is why it's an exciting moment to be looking at this market and the opportunities it presents.
So Mark, before we do move on,
a
question did come in from the audience, and maybe it might just need a little clarification. The question was, what are the primary sources of EUA allowance drawdown through 2030?
Yeah, well, essentially, it is a simple supply and demand question. The amount of allowances. So every year, the European Union makes a certain number of allowances available to the market. This is like on the oil market. The oil producers selling oil onto the market. The European Commission either auctions allowances or distributes allowances to industry free of charge. That is also changing, by the way, over time. And that's the total amount of supply every year. And so what I'm saying is, over the next 5 years, the total supply of new carbon allowances to the market will be significantly below the total demand for those allowances. So that is the source of the reduction in the inventory. And as I showed on a previous slide, we expect this year and next year in particular to be very tight, 150 million tons more or less each year of excess demand over available supply. And then in 28, 29, 30, it continues to be a market that is in deficit, less aggressively so. But you get that 500 million projected deficit cumulatively between 2026 and 2030, which means the total inventory in the market, as shown on this slide, declines by 500 million. And, that's a very significant change. Total emissions last year were about 1.1 billion tons. So the current amount of outstanding inventory that we show on the chart there of 900 million tons at the end of 2025, that's about 80% of annual demand, which is high for a commodity market. I mean, let's say that's 10 months supply, right? That is already out there in the market. In the oil market, it's typically 3 months inventory that is kept on. But what we see is by 2030, that number will be significantly lower. And it means industry will have to change their behavior and start hedging more aggressively and taking up the slack from the power sector. So this is a step change, and then we will have to see price discovery in these other sectors. Yeah. I hope that answers the question.
And Matt, Mark, you mentioned something there that you talked about, that there's, compared to a commodity market, there's a bigger balance. But it's important to note there's one balance. There's no one's adding supply to that. Whereas with oil, someone's pumping more oil.
Oh, absolutely, Luke. That's a great point. If the oil price goes to, for sake of argument, $100 a ton, you will find that all of a sudden people find new sources of supply that can come to the market. The point about this market is the supply is fixed in advance. We know what it is. Just because the price goes to, let's say, for sake of argument, 120 euros, there's not more supply coming to market. That's the whole point.
Yeah, and I think it lends itself to, and actually this is a follow-up paper we probably need to write, but this has sort of the benefits of commodities in that demand, supply, and diversification, but it doesn't have that disruptive nature. We saw natural gas prices in the US go up, 100%. But it was only in the front month. It was only if you wanted gas next month. If you want it in March or April,
exactly.
May, it wasn't expensive. And so we have something that prices a lot more on a flatter financial curve.
Yes, absolutely. Yeah. Well, I think I always say to people, if I'm giving a really basic teaching on this market, there are two distinguishing features of a carbon market relative to every other commodity market. Number one, this point we've been making about fixed supply and declining supply. You know what the supply is in advance. The point you give on the comparison you gave on gas is a very good one, because I can't tell you what the supply of gas is going to be next week, next month, next year. What we have with carbon is a very predictable trajectory for supply. The other distinguishing feature, which is different from any other commodity market, oil, gas, gold, you name it, you have producers and you have consumers. And the producers are the natural sellers and the consumers are the natural buyers. Here, the role of producer is being played by the European Commission, but they have told us in advance that the supply is fixed and it's declining. So the only buyers here are the compliance buyers. Of course, speculators, we've mentioned speculators, they're in the market and they provide the role of price discovery and give liquidity to the market, but they are not, they can buy and they can sell, but they are not the natural intended audience. The natural audience for this are the natural consumers, which are the companies that have compliance obligations. So that's what I mean when I say there are no natural sellers, there are only natural buyers. That's fundamentally different from any other commodity market out there.
And Mark, we had another question come in, and you just teed it up, so we're going to answer that, and then we'll move on to the other.
Sure.
But the question was, who are the principal buyers of this?
Yes.
And what are the
Yes.
differences between projects? And
yeah, absolutely.
to
So
clarify,
at the moment, the main sectors, industrial sectors that are covered by this market. So very, very quickly, this market covers 50% roughly of all emissions in the European Union. And it covers the power sector, the steel sector, the cement sector, oil refining, aviation, that is flights within the European Union, and now the shipping sector as well, which is all ships entering, all maritime operations entering the European Union. And the total amount of emissions there, as I said, is about 1.1 billion tons per year. So those are the main sectors that consume here. There is, I'll mention it in passing, it's not the subject for today. There is a new carbon market being developed by the European Union that will start in January 2028, which will cover more or less the remaining 50% of emissions in Europe that are not covered at the moment. That will be in the heating and transportation sectors, but that's best left for another day.
yes, but it's really worth noting that these buyers are not doing so because they want to, or they've committed.
Right.
This
They
is
don't have a choice. They don't have a choice.
Yeah.
If you want to remain a steel producer in Europe, then for every ton of CO2 that you emit in producing steel, at the end of the year, you have to submit a CO2 allowance.
Yeah. And then just on the last part of the question around, are there differences between the programs? Each has the same general broad objective and design, but they're very different. Different demand supply, different objectives, different things. So we can get into the next one.
Yeah, absolutely. Let's go. So I dwelt a long time there on the EU. We can run through the rest in quick order. So the UK market, I've called it there "sink to the link," and what I mean by that is UK prices, UK carbon prices, have started synchronizing with European prices because there is a lot of political momentum now around the UK linking its carbon market with that of the European Union. So if we look at the next chart, this is showing you the performance of UKAs since 2024. And what you notice is that they've run up very nicely. Indeed, as you said at the beginning, Luke, in 2025, UKAs were the best performing carbon asset in the world. They were up 72% in local currency terms, sorry, 76% in sterling terms, 92% in US dollar terms because of the depreciation of the dollar against the pound. And all of that appreciation in the UKA price was really driven by the market realizing that there is momentum around linking UKAs with EUAs, because at the beginning of last year, UKAs were trading at a very big discount to EUAs, and I think we show that on the next chart if we have a look. So you're seeing this so-called convergence play, and you can see at the beginning of last year, at the beginning of January 2025, there was a huge price differential between UKAs, which are the dark blue line on the bottom there, and EUAs, the light blue line at the top, where, and I've converted UK prices into euros for ease of comparison, and you can see at the beginning of 2025, EUAs were trading at sort of 75 euros a ton. UKAs were trading at 45 euros a ton, so a 30 euro discount between UKAs relative to EUAs. Now, over the course of the year, as we got more and more stories coming out that the UK government wanted to link its carbon market with the European carbon market, that price differential, as you can see very clearly from this chart, started to narrow, such that by the end of the year, it had narrowed from 30 euros a ton to 10 euros a ton. So that's been a really solid trade. And of course, because EUAs themselves also increased in value over time, you had two things going on. You had UKAs narrowing the discount to EUAs, and at the same time, you had EUAs going up, and there was kind of gravitational pull on the part of EUAs on UKAs. In other words, the UK was acting as the moon relative to the sun. The EUAs being the sun and UKAs being the moon. There was that gravitational pull which pulled UKAs up, and it got close, and the moon got closer to the sun as the discount narrowed. So that was a very interesting trade in 2025, and there is still some juice left in that trade because there is still a €10 discount, and politically both sides seem to be very keen to get this process finalized so that we can have a formal linking, let's say, in place probably by the end of 2027, beginning of 2028. And what that would mean, just people might think, well, what does it mean if you link one system with another? What it effectively means is if I have a UKA, I can use that either for my obligations in the UK, or I can use it, a European company can buy a UKA and use it for their compliance obligations in the European Union. By the same token, a British company that has obligations in the UK scheme can buy an EUA and use that for its obligations in the UK. So they become fungible items, in other words, and that's why this discount will continue to narrow over time as long as the political momentum for linking remains strong. And at the moment, it is very strong. So that's really the story on UKAs. They're a cheap proxy for EUAs. They have their own positive supply-demand story, by the way. This is not, disconnected from reality. The UKA market starts to tighten significantly from next year as well. But this linking to the EUA is the main story because the European market is much bigger than the UK market. So next slide, please. Yeah, this just shows you exactly what I was talking about. This is showing you the discount. So in fact, we got as high as a €42 discount at the beginning of last year in late January, and by the end of the year or end of last week, this had narrowed to kind of €8 a ton. So still some juice left in that trade. But this is what happens when carbon markets link. You get an erosion of the discount. So UKAs, we continue to like UKAs because of that gravitational pull from EUAs, basically.
So and a question came in here on UK, and the answer is, the question was, how much exposure do we have in KRBN? It's 5%. 5% of the portfolio is in UKAs.
Right. Yeah. Okay, so that's UKAs. I'm conscious of the time, so we should probably just get on to CCAs briefly at the end. So California, it's been a disappointing market over the last couple of years, but it's been disappointing because there's been a long delay, a political delay in releasing the key policy document that allows the regulator to finalize the legislation that will tighten the cap. The good news is 3 weeks ago, that document, that key policy document, was finally published, the initial statement of reasons as it's known, or the ISAW for short. And what that means is the California Air Resources Board, which is the market regulator for California carbon allowances, can now set in motion the formal timetable for finalizing the legislation and should be able to meet the deadline by which the market can be tightened from the 1st of January next year, and that will tighten the supply-demand balance in the California market quite significantly. So I think, again, if we look at the next chart, this shows you really how disappointing the market has been. If you go all the way back to sort of January, February 24, so exactly 2 years ago, we hit the all-time high in California prices. We got up to $46 a ton, slightly more than that on an intraday basis, because the market was excited all the way back then that we were going to have the ISAW published and the tightening of the market take place. In the end, for various reasons, which are shown on here, there were continuing delays. Last year, you'll remember there were the terrible wildfires in California that delayed the publication again, and for political reasons, it was thought sensible to produce a document that balanced the need for emissions reductions with the terrible damage done by the wildfire and the need to deal with that as a priority. But we now have that in place. We've also had the governor extend the lifetime of the project of the scheme beyond 2030 to 2045. So all the measures, policy measures, are now in place to tighten this market over the next 4 years. And we do have this federal potential federal challenge hanging over the market. And I'm sure everybody on this call is aware that the Trump administration last year published an executive order setting out. Clearly, we know that President Trump and his administration is not a fan of measures, carbon pricing measures to fight climate change. But this has already been litigated once already during President Trump's first term. So whilst there is some residual doubt over exactly what the federal government will do with regard to the Californian scheme and the other schemes in Reggie and Washington and so on, again, the market has absorbed that news quite comfortably. And I think now we're in a position to start rebuilding confidence in the market now that the ISOR has been published and the tightening of the market is known in advance. We know how the market will tighten over time. And I think I've just got one more slide that shows our expectations of the tightening of supply and demand. So the blue bars on this chart, again, as with the European chart, are showing you the expected annual supply-demand deficit or surplus. And going forward, this year we have a surplus, but then going forward after that, the market looks as if it's in consecutive annual deficits all the way through. So again, the inventory comes down. Exactly the same story as with the European one. The black line here on this chart is showing you the cumulative surplus to date, i.e. the inventory, the outstanding inventory in the market, and how we expect that to develop over time. And it comes down, I think, from 366 million at the end of 2025 to something like 166 million on the forecast of the that we have in our model, drawing on other sources and other market analysts and other commentators. So again, a constructive story, some residual political doubt. But the thing I'll just conclude with this remark, Luke, that we know with carbon markets, they move generally, the big moves happen when there are significant policy developments. And I think the only real doubt hanging over the California market now is this threat of federal action. I think over time, the market will become more comfortable with that risk because, as I say, this was something we went through during the first Trump administration between 2016 and 2020. So I think it's a slower burn story than the European story and the UK story, but you can see from this chart, the dynamics are the same, the fundamental principles are the same, tightening supply over time, reducing surplus over time. And again, this fundamental point in commodities trading, declining inventory means higher prices. So, and we're at the very, we're trading currently around $30 a ton. The high was 46 or slightly higher 2 years ago, and we've now finally got a position where the legislation can go through. So the floor price, by the way, and you mentioned in your introduction, Luke, that the floor price for California for next year, I think, is $27.50. So, it can't realistically go much lower. So if you think about the risk reward on California, it's good timing, really. It's a good level to be. You might have to wait, but the price level of entry here is attractive, we think.
Yeah, and Mark, I think I would say, in fact, I know we actually have that slide that I teased at the beginning, right behind this one, so we can go flip over to that. But I agree with you on everything. The one thing you said is this is a slow burn. I think it has been a slow burn. What's attractive about this market is that, unlike Europe, I think of one of them as you could think about this in terms of, cars. There's the reliable, solid family car that gets you from A to B and just keeps on running. And then you've got the sexy sports car that potentially is the most incredible investment you'll ever make, but it lets you down occasionally, or it's very temperamental. And that's what I think. So I see California as waiting for the stars to align, but they do need to align. Whereas in Europe, they're aligned.
Exactly.
And the reason I make that distinction is when I talk to people all day, as I know you do, about these markets. And when I present Europe and California next to each other, almost everybody says, okay, so California, that's the good one. That's the one I should be invested in. And I always have to say, well, I agree, but I also really like the balance that you get from Europe, because Europe maybe has less explosive upside potential, but it's more reliably going to have probably above market returns, whereas California may disappoint until it doesn't. And I think, as you said, the fact that California is now trading at its floor price means close to it. Disappointment means only getting the raise in the floor. And in fact, you said 27.5. It's actually already, that's where we are. We're just under 28 right now in 2026. And we'll be going up by 5% plus inflation. Right. So if inflation's 3%,
roughly 8%. Yeah.
8%. And you can see here, I really like this chart because the program's being extended to 2045. And so if we're trading right now just above the floor, and that floor goes up by 8%, give or take, a year till 2045, well, right. that alone, so forget even why, we think the market's going to tighten, we think prices are going to rise based on that demand supply. Even if you just bake in what the floor is going to do, we think that this is incredibly undervalued. So if the floor price is going up by 5% plus CPI, and this is why we've had quite a few endowments talking to us, because CPI plus 5 is a good return, especially when you've got downside protection at that level. So we just discounted back the future floor, and that gives you a price of $44 a ton, which is roughly the high in California, and we're trading about 30 or below $30 a ton right now. So very attractive entry point just for the structural floor price. If, as Mark pointed out, we see that surplus diminish into 2030, 2031, 2032, we start to move up to what they call the tier one, which is that orange line. And if we move up to that in the next few years, you can see in the insert box in the top left, those returns between now and 2030 look very attractive as well. So you almost have a bull case to those big numbers, and you have a neutral or bear case even that is also quite attractive, because you're going to be repricing up to that dotted blue line in the big one there. So happy to share this and answer more questions on email after the fact, but do want to be respectful of all the time. We do have questions coming in, but we did answer a lot as we went. So with that, I just wanted to flip over to one more slide here, just to kind of hit you with these numbers. You can see the risk and return of equities, bonds, carbon allowances, and you'll see Sharpe ratio, not dissimilar to equities, but with a correlation in the top right there of 0.3, 0.299. So an asset that has a Sharpe similar to US equities, but a correlation of 0.3, very, very interesting and worth looking at. And you can see what that does to an efficient frontier, pushes it out and to the left. You get that kind of correlation with that kind of Sharpe ratio, it can be very attractive. So I'll land us on the tickers here. And then, Mark, I'm going to see if we can get a question or two in under the wire. So let's have a look at this. So given this theme, this is a very interesting one, right? Given the theme we see here with very positive, constructive stories and structural benefits, why then, or what are investors saying? The person asking the question pointed out that the AUM of the funds is lower than it was 3 years ago. So what do you think is happening with investors?
Well, I think that the interest in EUAs has waxed and waned. You saw on that chart of the net speculative interest I showed. If you look at it over a 5-year period, the investors generally get very bullish when they think the market's going into a significant deficit, and What I think is happening now, on top of the fact that you've got these changing in deficits, is that 5 years ago we had deficits coming in, right? Because the market stability reserve, if you like, the central bank of the market, was removing allowances aggressively from the market. What's different here is this change in the pricing paradigm as well. So the expectation that prices can go quite a lot higher over the future as we get into price discovery. So I think, in my view, on European allowances, we're at as I said, a fundamental change in the pricing paradigm, and that's what makes this different from previous moments in the history of the market where prices have gone up.
Yeah, and I think it's worth knowing institutions that directly trade futures you're seeing that length. You're seeing them position, and our ETFs are lower assets than they've had in the past. We've certainly got a lot of interesting building around them. I do want to squeeze in. There's a really good question here. Assuming CCAs sit on the floor long term, how much would holding KCCA, which is our ETF, as an instrument, lag the actual CCA floor price? Great question. I'll also say that for different institutional clients, we also have a private fund that holds physical CCAs, whereas KCCA holds that exposure in the futures market. So the question, and I think what you're getting at, is a very intelligent question, which is there any structural cost built into holding futures? Because of course, if you hold commodities in futures, it's a complete wild card. You could spend 40% of your investment in rolling natural gas, for example. So the good news is carbon doesn't have that same feature. Carbon is more like a financial asset, has a more linear curve. The California curve, because it does have a 5% plus CPI, there's almost a little bit of premium in that curve. But that premium is about 150 basis points above the risk-free rate. And so what happens is you give us $1 million, we invest that in the futures, 100%, and then we put up the margin with the exchange for those futures, and the rest we achieve something like the risk-free rate or a little better. And so we essentially earn back the risk-free rate portion. So there is a spread, probably about 100. Historically, it's been about 100. It's about 150 currently. So I would say that if you're getting 8% step up from the floor price, you'll be giving up maybe 100 to 150 basis points just structurally in the way that the futures market works. Let me see if there's any other questions in there. And when I say that, that's not like a fee or anything. That's just the market structure. For a commodity, it would be, it could be tens of percents. Let's see here. Okay, maybe we'll just end on this, and then we'll make sure we get back to everyone that asked the question and left their name after the fact. What other markets are we looking at that we might include in the fund in the future?
Do you want to take that, Luke, or should I take it?
Sure. Well, I mean, for me, and for us both, I guess, I mean, we know that the other sort of interesting markets are, Australia and New Zealand, but they're not particularly big and they're not particularly liquid. Right. We always look at China, massive potential market. Arguably, it's the largest, has the largest emission base, but their program is designed a little differently, isn't completely liquid. South Korea is a great example that is a great market, is liquid, but it's not accessible to foreign institutions, so getting access to it is difficult. So we look at all of those things. We need this program. We need a program to be a cap and trade program. We need it to be accessible, and we need it to be liquid. The liquidity threshold's quite low. As long as we can trade 10 million or so a month, we're comfortable adding a small allocation to it in the fund and going from there. So right now, there's no new markets that we're looking at. The state of New York is considering a market. We did add Washington just last year, beginning of last year. So it is dynamic. We will add markets, but right now there isn't an obvious contender for that. Perhaps, Mark, is the secondary market in Europe, maybe one that develops.
Yeah, I think on a 2-year view, that's going to be, because that will have more or less the same size as the existing European market. So straight away, you've got a market coming in that's going to have depth, And there is already a futures market. It's not very liquid at the moment on that market, but I think it will be a very interesting one once we get closer to launch. I would say from the middle of next year, it's going to be an interesting one to look at.
Yep. And I don't want to keep everybody. If people have places to go, you will get the credit. You don't have to stay on any longer. Please send us that email. But maybe there's a question here. Somebody just asked a follow-up to the question on the California floor price, and saying it has traded below the floor. It did trade below the floor in 2019. It hasn't traded hasn't closed below the floor since then.
Right.
Yeah. So in April of last year, we had the executive order where there was a federal Trump put out an executive order that talked about energy independence in the US and talked about the fact that there shouldn't be state programs that interfere with energy independence and sort of free movement of power and everything else. Nothing has come of that yet. The market has started to sort of fade the risk of that, but it's always out there, which is what Mark talked about. But so intraday that day we dropped through the floor and immediately snapped back up to that floor, because the floor really specifically pertains to the auctions, which happen 4 times a year. But the mechanic is, if you trade below the floor, then there won't be any more auctions. Auctions will never clear below the floor. So what happens is that if you trade below the floor and stay there, then the supply in the market dries up pretty quickly. You tighten up, and then prices get pushed higher. So the mechanism holds very well. But to the person asking the question, very clearly, the floor price is not a floor price; it's an auction reserve price. But it acts quite firmly as an incentive to keep prices above there for that simple reason. And in fact, if the futures trade below the floor, you can simply buy them and sell auction futures and pretty much arbitrage that. And that's why it does act as something like a floor, but it's a reserve price. So happy to get into more technical questions like that. But that's what this investment in California looks like. We have a fund that's just California, and California is about 30%, 25 to 30% of our global fund, KRBN. So with that, Mark, I'm just going to ask you just one, but I know your answer. Yeah. This is an anonymous question, but which market are you most bullish on for 2026? And we'll end on that.
Yeah, I mean, I think both the European markets, the EU and the UK, are both looking very good to me. And I said, if you really held a gun to my head and said which one, I think the UK, just because it's got that extra little bit of juice in it, in terms of the discount, you'll have the gravitational pull from EUAs and the narrowing of the discount on top. So that's what my answer would be. But I think really there's not much in it. The European markets are poised for a very, very interesting year, I think.
I'd agree with that, except if we just see everything in California now fall into schedule, and by the middle of the summer we're on track to see the package approved. I think we've removed a lot of the hesitancy that people have to deploying to that market. So we could see a very interesting 2026 for the global fund and for the individual pieces as well. Yeah, so Mark, thank you so much. Looking forward to doing more of these with you. And yes, everybody, thanks for joining us.